All right, our final session today, rather than organized as a panel around a specific topic, is an open comment session. We'll be hearing from a variety of speakers. We do ask that all speakers limit their comments to 2.5 minutes. I do have a colleague who is off camera who will be providing time checks as needed. My role is simply to announce the next speaker, and I beg your forgiveness if I mispronounce your name in advance. Our first commenter is Mr. William Michael Cunningham.
Good afternoon. My name is William Michael Cunningham, economist, founder of Creative Investment Research, and adjunct faculty member at Georgetown University. My comments today reflect my work as an analyst, amicus brief author, and editorial contributor, focusing on financial stability, capital access, and impact investments. Over several decades, I have concentrated on identifying systemic risk. Prior to the 2008 financial collapse, I submitted comments to federal banking regulators, the Federal Reserve, FDIC, OCC, and SEC, warning that weak oversight and excessive risk-taking were creating systemic vulnerabilities. In early 2008, I highlighted the closure of Douglas National Bank, a black-owned bank, as an early warning sign of growing instability. The global financial crisis that followed demonstrated the importance of strong supervisory institutions. I have continued this work through formal amicus briefs submitted to the U.S. Court of Appeals for the D.C. Circuit and the Second Circuit, documenting economic harm arising from market misconduct and weakened oversight. More recently, writing in the American Banker newspaper, I've warned that political pressure on central banks risks triggering hyperinflation, threatens economic stability, and reduces access to capital for minority-owned businesses. Financial markets trust independent regulatory institutions. When that independence is questioned, volatility increases and credit conditions tighten. This concern is not theoretical. We are in an environment where scandal-related governance concerns and extreme misconduct raise questions about executive branch credibility. When confidence in leadership weakens, confidence in policy and regulation weaken as well. The lesson is clear. Strong, independent, credible regulatory institutions are essential. For EGRPRA, this means preserving Federal Reserve independence, maintaining strong supervisory authority, protecting regulatory credibility and transparency, and ensuring stable access to capital for minority firms and for small firms. My regulatory comments, public interest amicus briefs, and editorials all point to the same conclusion. Weakening regulatory institutions increases systemic risk. Strengthening them supports stability, growth, and access to capital. Thank you.
Our next speaker is Mr. Donald Cravens, Jr.
Good afternoon, everyone. Thank you so much. My name is Donald Cravens, Jr., President and CEO of the National Minority Supplier Development Council. I'm thankful to the Federal Reserve for holding this outreach hearing today and allowing for open comments. NMSDC connects more than 1,700 regional and local corporate members with over 16,000 certified minority business enterprises across the United States of America. As shown by their positive economic impact, these businesses are essential to our local, state, and national economies. Our most recent data shows that NMSDC certified MBEs generate nearly $600 billion in economic output, support more than 2.2 million jobs, and deliver $168 billion in wages to American workers. They are growing faster than the broader economy. This underscores a clear reality. Access to capital for small and minority-owned businesses is more than just a community or local job growth issue. Access to capital for small and minority businesses is a national economic priority. Small and minority business enterprises strengthen domestic supply chains across industries like infrastructure, logistics, construction, and technology. They hire locally, they build regionally, and they scale nationally. But when credit tightens, these small and minority businesses are often the first to be impacted. That disruption does not stop at the small business. It ripples across supply chains. It ripples across local, state, and national economies. As regulators consider modernization under EGRPRA, we urge a clear focus on preserving access to capital. Specifically, we recommend maintaining strong incentives for lending to small and minority-owned businesses, ensuring transparency in small business lending data, and supporting consistent access to working capital. Regulatory modernization should reinforce, not weaken, the financial infrastructure that enables businesses to grow, compete, and contribute at scale.
30
Thank
seconds.
you so much.
Our next speaker is Marissa Caldron.
Good afternoon, and thank you for the opportunity to speak. My name is Marissa Calderon. I'm President and CEO of Prosperity Now. For nearly 5 decades, we've worked with financial institutions and community-based partners to understand how finance systems operate in practice. That perspective allows us to see how reporting requirements, application processes, and examination expectations function across institutions and geographies. Many of the challenges that are often described as reporting burden or process inefficiency are, in our experience, a result of how fragmented the underlying system has become. Data is not consistently defined or shared across institutions, partnership models vary widely, and there's limited standardization in how activities are structured and documented. For example, mortgage lenders today report more than 100 data fields per loan under the Home Mortgage Disclosure Act, while CRA reporting requires separate and differently structured data collection across small business, small farm, and community development activities. These systems are not interoperable, and even federal analysis of CRA performance requires combining multiple data sets to assess outcomes. As a result, institutions and their partners often absorb significant operational costs simply to align and report on activity that is otherwise aligned in intent, with banks experiencing this as a reporting burden, while community partners experience it as friction. More importantly, this fragmentation makes it harder to move capital efficiently and at scale through the very systems CRA relies on. In turn, this contributes unintended variability into how CRA is applied and evaluated, limiting the ability to clearly measure and compare outcomes across institutions and markets. It also makes it more difficult for capital to reach communities in a consistent and scalable manner. We believe there's an opportunity to reduce unnecessary burden while improving clarity and consistency by focusing on greater alignment in data, measurement, and process. This includes how activities are defined, how they're documented, and how information flows between institutions and their community partners.
30 seconds.
Greater alignment and stronger supporting infrastructure would increase efficiency, strengthening the system's ability to deliver on its intended purpose. Thank you for your time and consideration.
Our next speaker is Thaddeus Dawson.
Hi, my name is Thaddeus Dawson. I'm the president and founder of 10KBA and the 10,000 Appraisers Foundation. I have been an appraiser for 40 years.
Next speaker,
My career,
Thaddeus Dawson.
I'm speaking now. I'm public. I'm online.
Yes. I apologize for the
Hello?
interruption. Please go ahead.
My name is Thaddeus Dawson. I've been an appraiser for 40 years. My career predates the Appraisal Foundation, FIREA, and Dodd-Frank. So I've had a frontline seat to watch the 38-year experiment called the Appraisal Foundation. This experiment has been a complete and total failure based on FHFA paper 2407 that states only 10% of all appraisals utilize market conditions adjustments. Well, if only 10% is utilizing market conditions adjustments, that means 90% are not using market conditions adjustments, and therefore the 90% failure. The best way that we can mitigate short-term is the codification of reconsideration of value. That is the most comprehensive wealth preservation plan that we have. That's also a law, and it's implemented by the VA. The VA actually has been doing this since 2003. Secondly, I've also submitted a white paper, and the long-term solution is the land grant reconstruction appraisal program, where we can fix and mitigate all that is wrong with the appraisal profession, although that's going to take some time. My third ask is that we abolish the appraisal foundation. It is a complete and total failure. There is no accountability in the appraisal process. And the appraisal foundation is not an authorized body to administer discipline. So there is no disciplinary measures or consequence. Thirdly, the new executive order, appraisal modernization through the new executive order in section 2.6 goes a long way to modernizing the appraisal process. We are definitely support that, and we encourage you to support it as well. As what it does is it pushes for a national license, and a national license is a solution. There is nothing uniform about the Uniform Standards of Professional Appraisal Practice. It's covered over 55 jurisdictions across the country with nobody having authority. And the Appraisal Foundation is lobbying against it as an unintended consequence. I think it's an intended consequence and the first step towards modernizing the process. Again, we have submitted a white paper on this very subject to the record, and we look forward to the appraisal modernization process. So we would like for you all to support the appraisal modernization process with the new executive order, as well as codifying reconsideration of value as the #1 consumer protection.
Our next speaker is Tate Hill.
My name is Tate Hill. I serve as the president and CEO of Access Plus Capital, a nonprofit small business lender based in Fresno, serving entrepreneurs across California's Central Valley. I'm here today to urge the Federal Reserve to protect and strengthen the Community Reinvestment Act as a part of the Economic Growth and Regulatory Paperwork Reduction Act review. The CRA remains one of the most effective tools we have to ensure capital reaches communities that traditional finance too often overlooks, particularly rural, agricultural, low-income regions like Central California. Since 2010, the banks have lent nearly $5 trillion in CRA-qualified mortgages and small business loans throughout the country, including over $717 billion in California. These investments translate directly into home ownership, small business growth, and economic opportunities. But from our vantage point on the ground, what matters most is how CRA works in practice. $8 billion in investments in places like Fresno and Madera County. In rural regions like ours, CRA is the mechanism that makes bank and CDFI partnerships viable. Through these partnerships, Access Plus Capital has deployed over $70 million across 2,000 small businesses in Central California. Importantly, we've directed over $15 million specifically to rural communities, areas where bank branches are sparse and credit gaps widen, while maintaining 96% loan repayment rate. That performance matters. It demonstrates that lending in rural and underserved communities is not only impactful, but is also prudent and sustainable when banks are able to partner with mission-driven intermediaries under the strong CRA framework. As regulators consider opportunities to reduce unnecessary regulatory burden under the Review Act, I urge this principle: streamline documentation and reporting where possible, but do not weaken the underlying CRA expectations that drive these outcomes. In regions like Central California, the CRA is not theoretical. Without it, capital simply does not flow at the scale our community needs. At a time when banking models are evolving and rural communities continue to face structural disinvestment, we need clarity, consistency, and strength in CRA implementation, not retreat. I urge you to maintain the strength of CRA so that banks, CDFIs, and community investment partners continue to deliver the measurable outcomes in places that need it the most. Thank you for this opportunity to comment.
Our next speaker is Kimberly Zito.
Great. Hello, everyone. Can you hear me okay? Perfect. My name is Kimberly Zito from Asian Inc. in San Francisco. We're also a member of the Rise Economy Coalition. I want to begin with a story. A few months ago, I met a small business owner in California's Central Valley, a first-generation immigrant who has spent years building a neighborhood grocery store. It wasn't just a store. It was where seniors and community members came for familiar foods, where new immigrants found their footing, and where a community stayed connected. When she first tried to expand her business, she was turned away again and again. Traditional lending channels didn't see her as bankable. It wasn't until a community lender, supported through partnerships incentivized by the Community Reinvestment Act, stepped in that she was able to access capital. That loan didn't just grow her business. It created jobs, stabilized the neighborhood, and helped a family begin building generational wealth. That's exactly what's at stake. Through the CRA, we've seen what's possible when banks are expected to invest in communities long excluded from the financial mainstream. In California alone, this has driven hundreds of billions of dollars into small businesses, affordable housing, and local economies. CRA lending and investment are profitable for banks and can open new markets to financial institutions. And yet the CRA has been effective in encouraging banks to do more in underserved neighborhoods than they might otherwise. It creates real pathways for families to access capital, build wealth, and achieve financial stability. These benefits come at minimal cost to banks, making efforts to weaken CRA obligations both unjustified and harmful, especially for rural and low-income communities. At a time when public funding for community development is declining, the CRA is more critical than ever in mobilizing private capital to meet community needs. Yet we are seeing a rapid push toward deregulation that risks undoing this progress. Accountability measures like public input are being weakened, while fair housing oversight and data transparency are being rolled back. This is not justified burden reduction, but a move that undermines the purpose and proven impact of these laws. The consequences are real, from reduced access to capital for small businesses to increased displacement, and communities push further into the margins. Regulatory reform must remain grounded in protecting consumers, ensuring fair access, and maintaining a safe and sound financial system by strengthening the CRA. Preserving community voice and recognizing that the cost of deregulation is borne by those least able to absorb it. The decisions made now will determine whether opportunity expands or contracts. We urge you to uphold the intent of these statutes and center the communities they were designed to serve. Thank you.
Our next speaker is Peter Hanley.
Good afternoon, and thank you for this opportunity to present today. My name is Peter Hanley. I'm Executive Director of CASA of Oregon. CASA works throughout the state of Oregon, mostly in rural areas, to serve the needs of farm workers, veterans, immigrants, and other low and moderate income populations. We do this through a number of programs, through our manufactured housing co-op development program, where we convert mobile home parks to resident ownership. We also build housing for farm workers and other rural populations. We run a IDA program, Individual Development Account program, that has resulted in about $316 million in purchased assets, with 5,000 savers in that program. And that program benefits first-time home buyers, entrepreneurs, as well as those wishing a college education. And we do all of this work with a $20 million CDFI. Now, each and every one of these programs relies on banks to assist our work. Our IDA program requires banks to not only work with us on the accounts where people save their money, but also when they eventually buy their asset in getting a mortgage or getting a business loan. On the CDFI side, a number of our loans are made in conjunction with other CDFIs, and so investments within our CDFI wouldn't have made our work possible. We've been doing this for 38 years, and we look at CRA as the nudge to get banks what they should be doing anyway, because it's good business, but they're doing it because there's an affirmative obligation to do it, and it should continue to be an affirmative obligation for them. It brings widespread economic benefits at a minimal compliance to the banks. A study of the Federal Reserve of St. Louis showed that less than 1% of interest expense. Now, in Oregon, since 2010, we've had about $819 million in CRA investments throughout the state. We believe that continued CRA investments are in the best interest of the communities that we serve, and we encourage that any regulation to limit those CRA investments should not be stopped, should not be put into place, and we would ask that you stop the repeal of the 2023 CRA regs. Thank you very much.
Our next speaker is Will Gonzalez.
Thank you for the opportunity to testify today. My name is Will Gonzalez. I am the Executive Director of SEBA, a coalition building organization in Philadelphia. CRA is a tool for economic mobility. It is a mutually beneficial tool with minimal compliant costs for banks. Without CRA, there are less opportunities for homeownership and entrepreneurship. I'll give you a story. Isaiah was growing up. His parents were able to move into a home that was developed with the help of CRA. With a stable home, he was able to do well in school. His parents also seized the opportunity to improve their workforce capacity. And now all of them, the whole household, is no longer low to moderate income. So that is income mobility. We are supposed to not spend more than 35% of our income on housing. Who does? Especially when it comes to lower income folks, they spend much more, 60, 70%. So affordable housing is really important to our community, and it is really good business for banks, because what you're doing is you're nurturing future customers, people who will get higher mortgages, people who will put more money in the bank, people who will start businesses. So it's very important that CRA continue to be a mutual beneficial tool for the community and for the financial institutions. Since 2010, banks have lent nearly $5 trillion in CRA qualified mortgages and small business loans throughout the country, including $173 billion in Pennsylvania and $96 billion in Philadelphia. The CRA increases the supply of affordable rental housing by driving investment and LIHTC, low-income housing tax credits. Banks account for about 85% of LIHTC investment. And with the changes that are coming at the federal level with increases in LIHTC, that tool will be further used by financial institutions. So we want to encourage that. Over the last 40 years, affordable housing activities of the SEBA Collective have built, thanks to CRA, 1,496 units of homeownership and rental, have repaired or preserved 10,270 units, and our partner CDFI has financed the construction of over 1,000 units. CRA protects the position of our community. It is good neighbor policy. It is a strong catalyst for meeting the housing supply challenges that we're confronting in this country. And it is an amazing tool to boost economic mobility for the benefit of our economy. Please stop the planned repeal of the 2023 CRA regulations, as these updates made the CRA more relevant to modern banking and will likely result in even greater economic benefits. Thank you for the opportunity to speak with you.
Our next speaker is DeMario Green.
Hello, my name is DeMario Green, and I'm the Policy and Government Relations Director for the Chicago Community Loan Fund. On behalf of CCLF, I'd like to thank the Federal Reserve for holding this hearing regarding the Community Reinvestment Act as part of the EGRPRA process. We are a 35-year-old community development financial institution serving the Chicagoland by financing the development of affordable housing, community facilities, commercial real estate, and social enterprise. In that time, we've closed nearly 700 loans, created or retained over 13,100 affordable housing units, and nearly 8,100 jobs. This impact is underpinned by our ability to attract public and private sector community revitalization capital that we've been able to leverage, thanks in large part to CRA. This law serves as a critical incentive for traditional banks to partner with community lenders who have the trust of underserved individuals in the hardest to reach geographies and the expertise to create wealth building opportunities in neighborhoods historically considered high risk. CRA plays a pivotal role in spurring New Markets tax credit program investment. CCLF has been fortunate to utilize this program both as a direct recipient and a bank partner. Our 2015 $15 million allocation empowered 3 historically underserved communities by increasing affordable housing options, expanding access to healthcare services, and bolstering educational opportunities for teens. As a partner, we helped create the North Austin Community Center Sports and Education Complex, serving over 25,000 neighborhood youth and families, and the Excess Tennis Center, the first tennis independent center on the South Side of Chicago and the second in the nation founded and operated by an African American. Beyond being sound and fruitful financial investment, these inspirational developments catalyze community transformation. Highlighted by the American Bankers Association, CDFIs are an essential part of the American financial ecosystem as we ensure that all communities, urban and rural, large and small, have access to the capital necessary to participate and contribute to our national economy. Updating the CRA to promote CDFI collaboration amongst eligible activities, adjust to the modern banking landscape, and collect data comprehensively will remove several outdated regulatory barriers that are blocking many Americans from accessing vital wealth building opportunities that align with this administration's economic vision. We urge regulators to look at their widely supported 2023 rulemaking as they work jointly to ensure that regulated entities continue to have dependable, unified rules to follow, offering both market stability and a fertile environment for community-focused collaboration. Let's work cooperatively to achieve these goals and restore the greatness of underserved American neighborhoods. Thank you.
Our next speaker is Linda Izuka.
My name is Linda Izuka, founder of CRA Today and the CRA Hub. I have over 32 years of banking, leading a large bank CRA program, serving on various nonprofit boards, and partnering with CDFIs throughout my career. I do not speak for the communities for which this law was designed to serve. I speak with the urgency of someone who has seen what happens when this regulation is applied well and when it is not. My first priority is exam transparency. Within the CRA Hub, we work with banks of various sizes across multiple agencies and exam cycles. I witness a consistent problem. Here's the scenario. Two similarly situated banks receiving materially different feedback with no written record of what was denied qualification despite multiple requests. I recommend that the regulators issue a written summary of activities not approved along with the bank's PE and implement it on an interagency basis. This could be a private, non-public communication to reduce regulatory burden. This paired with a published illustrated list of approved activities, banks would have the clarity to manage risk and build stronger CRA programs. My second point is financial literacy. Financial illiteracy costs Americans over $1 trillion over the past 4 years. Not one community, not one income bracket, every community, every family. Banks have a strong history of serving their entire community. I urge the agencies to extend service credit that benefit all because strong communities are built on financial knowledge, not just financial access. My third point is CDFI and bank partnerships. CDFIs exist to deploy capital where banks cannot always go alone. They are federally certified, they are mission verified, and yet investments in CDFIs face geographic restrictions that investments in MDIs do not. This restriction applied to CDFI is perhaps an oversight and a 1995 artifact. I urge the agencies to extend CRA credit to activities consistent with the treatment already afforded to MDIs, women depository institution, and low-income credit unions. I'll close with this. Clarity, consistency, and transparency will strengthen both CRA performance and CRA impact. This is what this regulation was built for. Thank you.
Our next speaker is Matthew Lee.
Sure. Thanks a lot. Thanks for this opportunity. On behalf of Fair Finance Watch and Inner City Press, I want to make part of the record in this paperwork reduction process the degree to which the Federal Reserve's merger reviews and refusal to review some mergers is increasingly excluding the public and undermining not only the Community Reinvestment Act, but also antitrust and even anti-money laundering principles. It's often said, particularly by the Federal Reserve, that the Federal Reserve is independent. But soon after the FDIC in late 2025 moved to stop providing public notice of branch applications, even though the CRA statute explicitly says that CRA performance is to be considered on applications for deposit facilities, the Federal Reserve began to follow suit. The board, through its reserve banks, which are owned by banks, told Fair Finance Watch that the issue of reduced public access was not an issue that the Fed would consider. Then when consumer complaints, some of bank fraud, are raised, including comments made to the CFPB, the board has said that these are not substantive and they won't be considered. No matter how bad the complaint, no matter how pervasive the practice, these determinations are designed to allow the Federal Reserve to confine some applications to the reserve banks, which have no authority to deny applications and can only approve them. The Fed did this recently on a UBS/Credit Suisse application, rubber stamping it at the reserve bank level, despite not only money laundering issues, but also issues still being reviewed in congressional committees. It gets worse. In late 2025, the Fed allowed an $8 billion bank acquisition by a bank holding company to take place with no Federal Reserve application at all. Just this month, when Finance Watch commented in advance urging the Fed not to waive the application requirement for an acquisition by stockyard banks, the Secretary wrote back and denied it. It only went to the Secretary because Stockyard Bank's CEO is on the board of a reserve bank. So we did a FOIA request because in light of the Silicon Valley Bank having been on the board of the San Francisco Fed when it failed, and we were told that there are no records of safeguards of these conflicts of interest. To me, it's not credible. And today we received a response to a November 2025 FOIA request, received today with no explanation of the 4-month delay. This also takes place on branch closing plans and branch mergers. On Fifth Third Comerica, they were released. In other ones, they're not released. There's no explanation of the lack of consistency. I could obviously say more. I'm trying to bring it in at time. In conclusion, I urge the Federal Reserve to reverse its descent into underregulation, willful blindness, and regulatory capture to avoid a repeat of the 2008 predatory lending meltdown. You will be hearing more from us. Thank you very much.
Our next speaker is Joan Broadhead.
Good afternoon. Thank you for having me today. My name is Joan Broadhead, and I'm the Chief Strategic Initiatives Officer at Finanta. Since 1998, Finanta has been a federally certified community development financial institution, and we now manage over $250 million in assets. For over 3 decades, we've provided financing to some of the lowest income communities in America, including the city of Philadelphia, Pennsylvania. We're deeply rooted in these communities, and we're focused on providing small business loans, community revitalization financing, and the critical development of affordable housing. It should be noted that the CRA increases the supply of affordable rental housing by driving investment in low-income housing tax credits, with banks accounting for 85% of LIHTC dollars. Another example is our partnering with our New Markets Tax Credit Program. In Philadelphia last year, we had worked with our longtime partner, PNC Bank, to finance a $30 million expansion of print ply manufacturing, which resulted in the increase of 50 jobs per year, and after 7 years will be over 350 new jobs, all earning living wage and health benefits. Similar to most CDFIs, we have significant investments in dozens of banks, predominantly funding that they provide to us in the form of debt issued to us for lending in our market. These banks include community banks, regional and national banks as well. An important aspect of these investments is the requirement that Finanta maintain its uninterrupted federal certification from the U.S. Treasury CDFI fund. As you can see, bank investments are essential to our ability to provide access to capital in low-income communities. Our concern is that the staff layoffs at the CDFI fund last fall have delayed the processing of hundreds of applications pending certification. We recommend that the agencies provide clear guidance to banks so that CDFIs can continue to receive consideration for financing despite the delays in CDFI certification processing. Again, we're very happy to have been here today, and thank you for the opportunity to provide comments.
Our next speaker is Sheila Collins. Sheila Collins. Let me suggest that we go on, and in that case, our next speaker will be Irvin Henderson.
Good afternoon. I am Irvin Henderson, President and CEO of Henderson & Company, a national developer of underserved communities throughout the country. I am a founding board member, former chair, and current vice chair of the National Community Reinvestment Coalition. I am also board member emeritus of the National Trust for Historic Preservation, chair emeritus of the National Trust Community Investment Corporation, founder and chair of Gateway Community Development Corporation in Henderson, North Carolina, and audit chair and trustee of Community Capital Trust, a $4 billion mutual fund dedicated to only CRA investments. My comments come from the perspective of someone who has been developing housing, commercial revitalization, and enterprise development in underserved communities, benefiting underserved families and individuals for 40 years. Without the CRA, these communities and families would have little or no investment over the last 30 plus years. Areas where the new market tax credit and the low-income housing tax credit provide opportunity would not exist because without the CRA, banks would not invest in the tax credit arena. Historic tax credit investment in emerging and underserved neighborhoods, which often are the core of our great cities and the rural areas that touch Appalachia, the historic South, and Indian country, would be greatly diminished. Renewable energy investment would shrink considerably. It is through these 4 tax credits and other bank investment satisfying the investment test that new investment capital has come to these needy communities. It is through these instruments that our federal government has supported reinvestment in poor communities, rural and urban. The 2023 rules supported these investments through direct investment and through national funds, such as the Community Impact Fund. It broadened and modernized the approaches to monitoring and crediting investment of the banking institutions outside of the traditional branch network. It can be said that the most efficient flow of private capital comes through these conduits. The compliance cost is acceptable, but a de-emphasis through the retrenchment to the previous rule does not consider the modernization of banking choices, activities, and growth. Small businesses throughout the country are receiving access to credit and capital, which feeds the lifeblood of our future innovation and market responsiveness as a country.
30 seconds.
All our large tech entities were originally small businesses. Many small business owners cannot depend upon friends and family for early stage capital, but bank small business lending and support of the CDFI lending is available to them because there is a CRA. These investments and loan products support the future of our country and are important to all Americans, not just those of need. It is simply the base and essence of free enterprise and must be maintained. Thank you, and thanks to the Federal Reserve for this forum.
Our next speaker is Emily Haber.
Hi, good evening. My name is Emily Haber, and I'm the President and CEO of the Massachusetts Association of Community Development Corporations. Thank you for the opportunity to share comments at this hearing. MACDC serves as the capacity building and advocacy arm of the community development movement in Massachusetts. We are an association of over 100 mission-driven community development organizations dedicated to creating places of opportunity where all people can live with dignity while participating in and benefiting from our Commonwealth's economy. Collectively, our CDC members achieved significant results. In 2024, our members created or preserved 1,095 homes, created or preserved 4,563 jobs, assisted over 2,000 entrepreneurs, provided a wide range of services and housing to 86,689 families, and generated $1.36 billion of investment into local communities. MACDC is a huge proponent of the Community Reinvestment Act. Our members partner with banks in all aspects of their work. Banks provide critical philanthropic dollars to our nonprofit CDCs. They provide the loans and investments for the critically needed affordable housing development in the Commonwealth, as well as loans to small businesses that are the economic engine in many of our neighborhoods. Governor Healy has challenged the housing development ecosystem to build 222,000 units of housing by 2035 to address our critical housing shortage. Bank participation is essential to meeting that need. For example, in 2024, Eastern Bank provided financing and/or purchased low-income housing tax credits for 5 CDC projects that are providing 186 much-needed units of affordable housing. And in fact, across the nation, CRA increases the supply of affordable rental housing by driving investment in LIHTC, with banks accounting for 85% of LIHTC investment dollars. Many CDCs also support their communities by providing technical assistance to small businesses that help them grow and ultimately access capital through the banking system. Since 2010, banks have lent nearly $5 trillion in CRA qualified mortgages and small business loans throughout the country, including over $168 billion in Massachusetts. Without CRA, there are fewer opportunities for homeownership and entrepreneurship. Studies conducted by the Federal Reserve of Philadelphia found that banks decrease their home purchase lending by 10% in census tracts that lose eligibility for CRA qualified loans. Small business lending also declines by nearly 10% in urban census tracts. The Federal Reserve should stop their planned repeal of the 2023 CRA regulations, as these updates made the CRA more relevant to modern banking and would likely result in even greater economic benefits. Thank you very much.
Our next speaker is Layla Hammerhamzen.
Good afternoon. Thank you for the opportunity to provide public comments today. Again, my name is Layla Hammerhamzen. I'm the Director of Community Reinvestment for New Jersey Citizen Action, a statewide community and coalition-based nonprofit organization that works to empower, organize, and mobilize communities through issue advocacy, education, and the provision of free direct services in an effort to eliminate social, racial, and economic inequities so that all New Jerseyans have opportunities to thrive and prosper. On behalf of the thousands of New Jerseyans empowered through our issue advocacy and free direct services each year, we appreciate the opportunity to comment today on the legacy of CRA regulations as part of the EGRPRA process. Since its passage in 1977, the Community Reinvestment Act has resulted in significant economic growth, opportunities, and overall benefits to communities, including New Jersey communities, with minimal compliance costs for banks, including those with less than $10 billion in assets. These economic opportunities include ensuring that our communities, including low and moderate income communities and communities of color, have access to homeownership and entrepreneurship opportunities. CRA has also driven investment in affordable housing and investments in community development, financial institutions, and economic and community development in general. Since 2010, banks have lent nearly $5 trillion in CRA-qualified mortgages and small business loans throughout the country, including $138 billion right here in New Jersey. Without CRA, there would be significantly less opportunities for homeownership and entrepreneurship. In fact, studies conducted by the Federal Reserve of Philadelphia have shown that when census tracts lose eligibility for CRA-qualified lending, banks decreased their home purchase lending by 10% in those neighborhoods, and small business lending also declined by nearly 10% in urban census tracts. With regard to affordable housing, the federal CRA increases the supply of affordable rental housing by driving investment in low-income housing tax credits, or LIHTC, with banks accounting for 85% of LIHTC investment dollars. As a state that is currently facing a severe affordable housing shortage of nearly 300,000 affordable rental homes and the 7th highest housing wage, according to the National Low-Income Housing Coalition's Out of Reach report,
30 seconds.
The importance of CRA cannot be understated. The overwhelming success of CRA is that it is able to generate this investment in our communities, all of while its compliant costs make up less than 1% of non-interest expenses. We urge federal regulators to stop their planned repeal of 2023 CRA regulations, as these updates made CRA more relevant to modern banking, which has clearly changed dramatically since the law's passage and would likely result in even greater economic benefits to our underserved communities. Thank you so very much.
Our next speaker, let's try Sheila Collins.
Can you hear me?
Yes, we can hear you. Please proceed.
Okay. Good afternoon. My name is Sheila Collins, founder of Girlfriends Who Inspire Change, a global women empowerment network focused on economic mobility, financial literacy, and wealth building opportunities for underserved communities. I am here today to speak on the impact of the Community Reinvestment Act and how its implementations can better serve low and moderate income individuals, particularly women working to stabilize and elevate their financial futures. At GWIC, we work directly with women navigating financial hardship while striving to build sustainable income and generational wealth. What we are consistently see is a system that provides access to credit but not protection and pathways forward. For example, institutions such as Bank of America offer small dollar loan products intended to provide short-term relief. However, when a borrower, such as a single mother working a low-wage job, experiences even minor delays in repayment, the consequences can be long-term, even when the loan is paid in full. Negative credit reporting can significantly damage her ability to secure future housing, business funding, and financial stability. That is not empowerment. That is a cycle. The issue is not access, it is outcome. Under the CRA, success should not be measured solely by the number of loans distributed, but by whether those loans actually improve economic mobility. At GWIC, we believe CRA policies must evolve to include credit building protections for small dollar loans, alternative reporting structures that do not penalize short-term hardship, and a strong focus on measurable pathways out of poverty, including support for entrepreneurship. If we are serious about equity, we must move from transactional banking to transformational impact. The CRA was designed to reinvest in communities. Now is the time to ensure that investment truly builds, not breaks, the financial futures of people it's meant to serve. Thank you.
Our next speaker is Susie Hahn.
Hi, thank you to the Federal Reserve Board for hosting this outreach session and the opportunity to speak on the CRA. I'm Susie Hahn, VP of Regulatory Affairs at Opportunity Finance Network, OFN. We're the nation's leading network and intermediary representing more than 500 community development finance institutions, CDFIs, and manage over $1 billion in total assets as a CDFI ourselves. OFN members are vital CRA stakeholders. Our members, thanks to CRA-motivated capital, often work in credit deserts in rural, urban, and Native communities across the United States to correct market failures. Since our founding in 1986, our members have originated $111 billion in financing, creating or maintaining more than 3 million jobs, supporting 850,000 small businesses, 2.4 million housing units, and 14,000 community facility projects. Within our own membership network, we found that 46% of CDFI's capital stack came from banks, totaling $6.17 billion in FY24. This is a significant demonstration of partnership that shows how closely CRA-motivated banks work together with CDFIs to drive private dollars into the most hard-to-reach places. Without CRA incentives, many communities will continue to be excluded from fair access to credit and investment. Projects that serve low and moderate income communities often leverage low-income housing tax credit and new markets tax credit. It is estimated that over 80% of annual LIHTC and NMTC equity investments come from CRA-motivated banks. Under the legacy CRA framework that is currently in place, we share the regulator's objective of sharpening this important tool by reducing inefficiencies. But the regulator's recent changes overweigh the compliance burden for banks, while undervaluing the lost opportunities for investment into LMI communities. The OCC strategic plan simplification could weaken CRA impact without clear benchmarks and rigorous minimum standards, encouraging investment in easier geographies while bypassing rural and deeply distressed areas that the CRA is meant to serve. The FDIC has also reduced CRA exam cycles to 5 to 6 years and replaced full exams with mid-cycle risk reviews for nearly all banks, weakening sustained focus on community development. On the other hand, explicit interpretive guidance could improve transparency and streamline processes. For
30
example,
seconds.
Publishing an illustrative list of qualifying CRA activities, clarifying broader statewide or regional area, giving equal treatment to CDFI loans and investments, and differentiating high-impact activities with greater weight can reduce subjective variability that would be well appreciated by CDFIs and bank partners. We also urge the regulators to work jointly so that any new guidance is implemented uniformly across the three regulators to avoid fragmenting a fair framework for all examinees. Another timely concern is around CDFI certifications. We ask that the regulators consider providing more clarity for CDFIs who are undergoing the certification process, and interagency guidance on how banks can continue to receive CRA credit for financing CDFIs despite delays in certification decisions would be welcomed by all parties. Thank you for all the regulators' continued efforts to consider the diverse set of perspectives and a holistic cost-benefit approach that fully acknowledges the CRA's impact in low-income and underserved communities.
Our next speaker is Sugita Kurata.
Thank you, Federal Reserve. Thank you for the opportunity to speak today. My story begins long before this room, in another country, another financial system, where I first learned how innovation and regulations dance with each other. When I came to the United States on an H-1B visa, I carried with me not just technical skills, but a habit of observing how systems evolve and where they quietly fall behind the world they are meant to govern. Working across banks, fintechs, and third-party providers, I started to notice a pattern. It felt as if the industry was living in two timelines at once. The present, where technology moves at the speed of thought, and the past, where some of our frameworks still echo the economics of decades ago. I would sit in meetings where teams wrestled with thresholds set in another era, or where smaller institutions were navigating structures built for giants. No one complained, but you could feel the friction like a violin silently, not in tune. I remember once, project vividly, we were operating to launch a digital onboarding tool. The idea was bold, the technology elegant, but the path forward felt heavier than it needed to be. Instead of pushing ahead blindly, we carved out a small pilot, a safe space to learn. The pilot revealed insights we would have never seen at a full scale. It taught me that innovation doesn't need to be reckless to be fast. It just needs room to breathe. I have seen similar moments with third-party partnerships, cloud providers, fintech collaborators, regulatory service vendors. They are now part of the bloodstream of modern finance. But the visibility into those relationships often lags behind their importance. It's like driving a modern car with an old map. You can move, but not with full confidence. And then there's the human side. I have watched brilliant teams spend weeks producing documentation that no one truly needed, simply because expectations felt uncertain. It
30
reminded
seconds.
me of people building walls for protection when what they really needed was a clear path forward. All of these experiences shape the vision I carry with me today, a regulatory environment that moves in harmony with the economy it serves, one where clarity replaces hesitation, where oversight matches actual complexity, where innovation is guided rather than restrained, and where collaboration across banks, non-banks, and regulators becomes the norm rather than the exception. If we can align our framework with the realities of today's financial ecosystem, we can build a system that is both resilient and imaginative, one that protects consumers, supports competition, and gives institutions the confidence to innovate responsibly. Thank you again for the opportunity to share my story and my perspective. Thank you, Federal Reserve.
And our final, I believe, speaker is Erica Plasencia.
Hello, my name is Erika Plasencia, and I'm the Senior Program Manager for Economic Equity at the Greenlining Institute, based in Oakland, California. Thank you for the opportunity to provide public comments on the Legacy Community Reinvestment Act regulations as part of the EGRPRA review process. At Greenlining, we work towards a future when community where communities of color can build wealth, live in healthy places filled with economic opportunity, and are ready to meet the challenges posed by climate change. We proactively drive investments and opportunities into communities of color alongside a coalition of over 40 grassroots, community-based organizations, including minority business associations, community development corporations, and civil rights organizations. In my role, I serve as a bridge between communities and financial institutions, ensuring that public processes center the needs of low-income communities and communities of color. The CRA has been instrumental in that work. It has helped us successfully advocate and negotiate initiatives directing more than $800 billion in corporate and public investments into communities of color in California and across the nation. These are not abstract benefits. They are investments in housing, small businesses, and community infrastructure that strengthen our broader economy. This is why the proposed rollback of the 2023 CRA rule is so concerning. These updates made the CRA more relevant to modern banking by recognizing how financial services are delivered today. They expanded and clarified community development activities, including critical investments in climate resilience, and such as renewable energy, flood mitigation, and resilient infrastructure. This is essential as the same communities historically impacted by redlining continue to face disproportionate economic, health, and climate risks. At the same time, we are seeing increased consolidation across the banking industry. As mergers accelerate, CRA obligations are effectively weakened. Public engagement is reduced, accountability diminishes, and communities are often left worse off. Since 2021, 1 in 5 bank branches have closed, with a disproportionate share of closures occurring in LMI communities and communities of color. These closures reduce access to safe, affordable financial services and eliminate local jobs, further destabilizing already underserved areas. Mergers should leave communities better off, but too often they do not. This is why robust CRA enforcement, meaningful public participation, and tools like community benefit agreements are essential to ensure institutions truly meet the convenience and needs of communities they serve.
30 seconds.
Reliable access to banking is not optional. It is foundational to economic mobility and wealth building. When communities are excluded from credit and investment, they are pushed toward predatory financial services, deepening wealth disparities and increasing economic vulnerability. This does not just harm those communities, it weakens the resilience and stability of our entire financial system. Moreover, maintaining a strong CRA is not in conflict with economic growth. It is foundational to it. Broad-based access to credit fuels entrepreneurship, stabilizes housing markets, and builds local economies. Weakening CRA does not reduce burden. It shifts risk and costs onto the very communities that can least afford it. Instead, the agencies should reverse their plans to repeal the 2023 CRA rule that implemented several needed updates, clarify how banks can receive consideration for community development in communities with minimal branch networks, and continue to receive credit for financing CDFIs. Thank you for your time and consideration today. Have a great one.
Thank you all. So this concludes our fourth and final outreach for this EGRPRA regulatory framework review. There are 2 groups that I certainly want to signal out and thank. First, an event like this doesn't happen without meaningful staff support, and this event went very smoothly, and we're very grateful for everybody who helped make it happen, so thank you. And then even more importantly, I want to thank all the participants, particularly those that provided public comments today. Thank you for your commitment of time. Thankful for your thoughtfulness. Thank you for the energy that you put into those comments. We are truly grateful. Public comment collected today and in similar outreach events and through other public comment processes are essential for the regulatory agencies to consider as they attempt to improve our framework. Please be assured that your feedback will be considered as we move forward in the EGRPRA process. And again, thank you all.